Welcome to the latest edition of Fitch's Virtual Investor Series. I am Maria Paula Moreno, Head of North American Structured Finance. Today, as we look to discuss the 2023 mid-year outlook and rating performance for North American RMBS, I am joined by my colleague Kendra, Head of our North American RMBS sector. With 6 months into the year, we're seeing world economic activity holding up better than expected, helped by an easing early adverse supply shock. But with inflation proving stubborn and labor markets remaining tight, central banks continue to tighten monetary policy. The impact of this tightening on the consumer and on the overall mortgage market still lies ahead and could be amplified by more restrictive bank lending conditions as central banks withdraw liquidity. So to start, Kevin, maybe if we touch on the housing market, how have Fitch's expectations changed since the beginning of the year?
Sure. So we started the year going into thinking that nationally home prices would be flat to maybe down 5% in that range. But through the first quarter and through the first half of the year, we're seeing actually home prices are up 1.5%. So we saw a dip in mortgage rates, which then prompted some buyers, and we saw a lot more new home price and home buying activity actually in the market in the first half of the year, actually driving prices up. We've seen mortgage rates actually increase a little bit, bump back up a little bit since then, and so we're now expecting that we're keeping the flat to down 5% for the year-end total.
And is this consistent, Kevin, across the country?
We're seeing regional differences for certain, where MSAs that we saw large increases through the pandemic out west, we're seeing those have the highest decreases. So we see more decreases in the west, and we're seeing slightly more increases or holding steady on the East Coast. On a sustainable level, one of the things we see is at the height of the pandemic, we were believing that nationwide we were 11%, a little over 11% overvalued. We see that actually coming down now. So we're now only seeing about 7.5% overvalued in the across the country because you've seen sustainable levels rise with rents.
Kevin, you briefly touched on mortgage rates. Maybe if we go into the mortgage markets, what are we seeing?
Yeah, so the drastic increase in mortgage rates have shifted all of the mortgage lending activity to new purchases away from refinancings. And so that's really having a big impact. We're seeing stretches on affordability. Home prices have elevated, mortgage rates have elevated, so you're seeing a lot of pressure on affordability, so you're starting to see more affordability products like adjustable rate mortgages. We're also seeing you've had higher home prices, home price growth, and you have a lot of borrowers with very low first lien mortgage rates, so you're seeing a lot of home equity products as well.
And how are these two concepts tying into the securitization market?
Well, we've seen a significant shift away from prime issuance, which was largely the refinance activity we saw through 2021. We're seeing that shift squarely into the non-QM, the non-qualified mortgage activity. They represent more than 50% of any kind of monthly issuance. You're seeing other issuance like home equity loans, home equity lines of credit, close-end seconds. You're seeing products there. You're seeing a lot more of the properties where the borrower is actually qualified under a debt service coverage ratio. These are business purpose loans, and these are rental activities. So we're seeing a lot more of that activity in this current market.
And what are we seeing regarding performance?
Well, performance is still strong, right? So we had such rapid increases in home prices. What we're seeing now is even when we were taking the sustainable home price view of an 11% haircut, what we're really seeing is even when we have a small decrease, that's just getting back to our base case. So we see strong performance. We're seeing the borrowers still holding up. We haven't really entered an economic recession, so we don't see any increased delinquencies. And so we actually see the ratings are still stable, and we still expect upgrade pressure.
And maybe to wrap up, Kevin, what do we expect or should expect for the remainder of the year?
It's an interesting question. I think issuance volumes will continue to move along depending on where mortgage rates go and what happens with the economy. But we're seeing a very steady, healthy flow of new deals, and I would expect to see that the existing transactions will continue to perform because we're really not projecting that much of a housing market correction.
Thank you for your insights, Kevin, and thank you for joining us today for this edition of Fitch's Virtual Investor Series. For more insights on North American RMBS, please visit fitchratings.com. And if you have any questions on any of the topics discussed today, please feel free to send an email to the address on the screen. Thank you for watching.